Welcome to our course, Introduction to Financial Statements, and thank you for choosing this course and joining me on this journey. And I am your instructor, Chris Ivory. So our course goals. Our first goal is just to simply learn what the financial statements are, which is our balance sheet, our income statement, and our cash flow statement. After that, I'm going to teach you how to build your own financial statements, and I want you guys to be confident with building your own financial statements and not worry about messing that up. And the next goal is also to be confident that you can analyze the numbers in the financial statements. And our last goal is just for you to simply understand what the numbers in the financial statements are telling you. A lot of people can see the numbers and tell you that line item means, but they can't tell you what it means for the company. So I want you to know what these numbers mean for your company after you analyze your financial statements. Thank you once again for choosing this course. Now let me give you a quick overview of what we'll be learning in this course. First, I'll give you an in-depth description about each financial statement and all line items in the financial statements. And your three financial statements are your income statement, your balance sheet, and your statement of cash flow. Then after that, we'll be learning how to build and also integrate each financial statement. So a change in one of these statements will automatically update all of the other statements as well. Next, we'll be learning the schedules that go along with their statements, the debt, so how we're keeping up paying off our debt. You'll also learn the PP&E schedule, which has to do with our plant, property, and equipment, and our depreciation schedule. And lastly, you'll be going over ratios to help you analyze these numbers and what they mean for your company. So what are financial statements? The three financial statements most commonly used by businesses are the income statement, the balance sheet, and the statement of cash flows. These three statements are important because it allows a company to maintain an accurate account of their financial situation. It also allows companies to perform analysis on their data to make predictions about the future of their company. These statements must adhere to the generally accepted accounting principles, also known as GAAP, so that businesses across international borders maintain continuity of information and presentation. Companies' financial statements are often audited by government agencies, accountants, and firms to ensure accuracy of the statements. So let's start with the balance sheet. The balance sheet provides an overview of assets, liabilities, and stockholders' equity as a snapshot in time, which is generally at the end of the fiscal year. The balance sheet equation is assets equals liabilities plus stockholder equity, because assets are paid for with either liabilities such as debt or stockholders' equity such as retained earnings and additional paid-in capital. Assets are listed on the balance sheet in order of liquidity, meaning what can be turned into money the quickest. Liabilities are listed in the order of which they will be paid off. Short-term or current liabilities are expected to be paid within a year, while long-term and non-current liabilities are debts expected to be paid off after 1 year. Now let's move on to the income statement. Unlike the balance sheet, the income statement covers a range of time, which is a year for annual financial statements or a quarter for a quarterly financial statement. The income statement provides an overview of revenues, expenses, net income, and earnings per share. It usually provides 2 to 3 years of data for comparison. Now moving on to the statement of cash flow. The statement of cash flow merges the balance sheet and the income statement. Due to accounting convention, net income can fall out of alignment with cash flow. The cash flow statement reconciles the income statement with the balance sheet in three major business activities. These activities are the operating, investing, and financing activities. Operating activities include cash flows made from regular business operations. Investing activities include cash flows due to the buying and selling of assets such as real estate and or equipment. And financing activities include cash flows from debt and equity. This is where analysts can also find the amount of dividends paid and or dollar or shares repurchased. And these are our financial statements. It's just a quick overview of what financial statements are. So let's take a more in-depth look at our balance sheet. Our balance sheet provides an overview of our assets, liabilities, and equity as a snapshot in time, which is usually at the end of our fiscal year. The balance sheet equation is our assets equals our liability plus equity. because our assets are paid for with either liabilities such as debt or our equities such as retained earnings. Assets are listed on the balance sheet in order of liquidity. Then we have our liabilities, which are listed in order with what will be paid off first. Our short-term liabilities are expected to be paid off in a year, while long-term liabilities can be paid off in over a year. And lastly, we have our equity, which is the amount of money people have invested in us or that we have retained from our own investments. So let's go over our balance sheet line items. Our first thing is our current assets. So which it's our assets that can be turned into cash quick or most liquid. So cash is our first line item, which is cash. You know what that is. Then we have our accounts receivable, which is the money owed from to us from products that we have sold. So normally those accounts will be paid off in within 30 days. Then we have our inventory, which is all of our products that we have in store. Then we have our prepaid expenses, expenses that we have already paid off. So then after that, you add all those up and we'll have our total current assets. Next line item are our fixed assets. Right here, we just have our PP&E, which is our property, plant, and equipment. So this is our property, so our buildings that we own, any equipment that we own. And net accumulation depreciation means that we're taking away the depreciation each year in our balance sheet from our equipment or our property or our plant, wherever we are. Because as I said earlier, our assets depreciate over time just like a car will. And then we have our total assets, which is our current assets plus our fixed assets. Then you have your total assets, which will be equal to your liabilities and your equity added together. So next here we have our current liabilities. Our current liability starts with our accounts payable. So these are our short-term liabilities, and these are things we have to pay off quickly. So our accounts payable are normally to be expected to be paid within 30 days. Our line of credit, this is the money that we've been borrowing on credit, and our current maturities of long-term debt. So the long-term debt that is now due within a year. Next, we have our long-term liabilities, which is our long-term debt that's due to be paid off over a year from now. Then we have our total liabilities, which is our long-term liabilities plus our total current liabilities. Next, we have our equity. So we have our common stock. This is our stock that we have put out from our IPO and going public. So people can buy stocks, so how much money we have from stock. Then we have our additional paid-in capital. This is money that we can use to pay off our liabilities if need be. And then we have our retained earnings, which is the earnings that we put back into our company from our earnings from the previous year. And then we have our total equity, which is all of these lined up together. And then we have our total liabilities, equity, then we have a check. So we added our total liabilities plus our total equity, and we subtracted that from our total assets. And since our equation is total assets equal liability plus equity, our check should come out to zero. And as you can see here, everything has come out to zero, which is a perfect. That means that our balance sheet is balanced perfectly. And then lastly, we have our balance sheet of assumptions with our account receivable days, our inventory days, and our accounts payable days. So on average, how long are we waiting to get our accounts receivable paid, and how long is our inventory staying in stock before we sell it? For our inventory days and our accounts payable days, how long does it normally take for us to pay off our accounts payable? How long will we have the money for that? And this is an overview of the balance sheet. So now let's take a more in-depth look at our income statement. And just to quickly review, the income statement provides an overview of our revenues, expenses, and our net income. And it usually covers a multi-year period to take a look at it. So our first line item on our income statement is our revenue. And our revenue is simply our amount of goods sold times our sale price. So if we had 10 shirts that we sold and we sold each shirt for $10, then our revenue would be $100. Now let's move on to our cost of goods sold. Our cost of goods sold is how much it costs to make each good that we're selling. So if once again, we sold 10 shirts, but it cost us $3 to make each shirt, then our cost of goods sold would be $30. Sorry for that math mistake. Now let's move on to our gross profit. So our gross profit is simply our revenue minus our cost of goods sold. So what we have our revenue was $100. We sold 10 shirts for $10 each, and it cost us $3 to make each shirt. So it'll be 100 minus 30, which will make our gross profit 70. Our next line item is our operating expenses, our SG&A as they call it. And these are expenses that just kind of help our company move on. It's the people that work, the salaries, everything that helps our company operate as it says. And these expenses, once you take them out of our gross profit, leaves us with our EBITDA, also known as our earnings before interest, taxes, depreciation, and amortization. So this is after subtracting our operating expenses from our gross profit. This is the number we will get. Our next line item are our depreciation and interest expense. Our depreciation is how much money that we are losing from the equipment that we buy. So it's like a brand new car. Once you buy it, you start losing money, the value goes down. So same thing with the equipment that we're using to make our products. Once we buy it each year, the value on it goes down and we're losing a little bit more and more of our assets. Now interest expense is simply just how much we have to pay interest on any loans we may have that we've taken out or any other liabilities. So next we have our pre-tax income, which is our income after we subtracted our interest, our depreciation, and if you have amortization, you subtract that. So it'll just be our earnings before taxes or pre-tax income. And then you have your income tax expense, whatever your state regulation is on your income tax, so however much you have to pay. And once you subtract that, we finally have our bottom line, which is our net income. And this is the number that everybody wants to see. Some people might say they have great revenues, but if their cost of goods sold is so high, it leaves very little profit margin, or if your expenses are so much. So your net income is how much you actually profited after taking out all the expenses in a year. So that is your income statement. Quick and simple overview. Now let's take a more in-depth look at our cash flow statement. So our cash flow statement shows our cash flow from three major business activities. These activities are our operating activities, our investing activities, and our financing activities. Our operating activities include cash flows made from regular business operations. Our investing activities include cash flows due to the buying and selling of assets such as real estate and or our equipment. And lastly, our financing activities include cash flows from our debt and our equity. And this is also where our analysts can find the amount of dividends paid. So let's move on to the cash flow statement. So as I said, our first activities are our operating activities. And our top line is our net income, which we took straight from our income statement. And then the first thing we have to do, we have to add back our depreciation, our amortization. So we have the lines depreciation, as you can see, we're adding it back over the years. And then we have our changes in working capital. So our change in working capital works as we'll take our over a 2-year period, we'll take the change in our account receivables from the year before to the current year. And we do the same thing with our inventory and our accounts payable. And after adding all these numbers together, we'll get the net cash provided by our operating activities. Next, we have our cash flow from our investing activities. And as you can see here, we invested in our capital expenditure, which is the purchase of our property, plant, and equipment. And since we invested this money, we bought it, it shows up as a negative because it's money that we put out, not that we made. So that's negative. And then our cash flow from our financing activities, and we have two line items here: our revolving credit, our line of credit, and our long-term debt. So this is money that we owe. So once again, we're losing money. We're not gaining any money from it. And lastly, down here we have our net cash flow for the current year. So we get that by adding up all the cash flow activities. And then we take our beginning cash balance, so that would be our cash balance from the previous year, and we add that, and then we'll get our ending cash balance for the current year. And every year we'll use our ending cash balance for our beginning cash balance for the next year, and we'll just add that to our net cash flow, and you can see what free cash we have floating around. So our free cash flow from our cash flow statement, and this is how a cash flow statement works. Now we're at the building financial statements section. So what we're going to learn how to do is build financial statements. We're going to first learn how to build our income statement, our balance sheet, and our cash flow statement. And you see how these statements flow into each other into the next one and how they overlap in some areas. And we're going to combine these statements so when you update one, it'll automatically update the others as well. We're also going to learn how to balance a balance sheet, which is making sure our assets equal our liability plus our equity. And lastly, we'll learn how to build our supporting debt and PP&E schedules, which will help us with things as long-term and short-term debt that we have to pay off in our liability section of our balance sheet. And we'll also learn our PP&E schedule, which will help us with our depreciation over the years and learn how we're paying that off as well. So to get started with our financial modeling section, we'll need to begin with our income statement. And I have already created a template for you guys that you guys can go ahead and download, or you could go ahead and fill it in yourself if you feel like you need to practice. So the first line of our income statement is our revenue. Then we have our cost of goods sold. Then we have our gross profit, which is our revenue subtracted by our cost of goods sold. Then we have our SG&A, or operating expenses. And then we have our EBITDA, which is our earnings before interest, taxes, depreciation, and amortization. Now, the formula for that will be our gross profit subtracted by our operating expense. Then we have our depreciation expense, our interest expense. Then we have our pre-tax income, which is our EBITDA minus our depreciation and interest expense. Then we have our income tax expense. Then lastly, we have our net income, which is our pre-tax income subtracted by our income tax expense. So now let's go ahead and work on filling in the rest of this income statement. So first we have to work on our growth percentage for our revenue. The first year will be non-applicable because we don't have any revenues from the year before to compare our growth. So our formula for our second year will be our revenues from 2016 divided by the previous year. From 2016 divided by the previous year minus 1. You can see our growth percentage was 5%. And here for our cost of goods sold as percentages of our sales, the formula would be our cost of goods sold divided by our revenue. And we could go shift right arrow and then control R to quickly fill that in. Same thing with our gross profit as a percentage of our sales. Our gross profit divided by our revenue, and we could quickly fill that in. And same thing with our operating expenses as a percentage of our sales. We'll divide that by revenues, and we could go ahead and quickly fill that in. So for our revenues, we'll need to come up with an assumption that our growth will be, and we'll go with 7% as our assumption. And now we can fill in our revenue line. So it'll be equal the year before times our growth rate plus 1. And we could go ahead and hold shift and then press Control R to fill this in. And we could go ahead, we'll come back and format the numbers the way we like at the end of filling in all these line items of our income statement. So next we'll have to work on our cost of goods sold. So to do this, we'll take the average percentage of sales from our historical data, and let's go ahead and lock this by pressing F4. We need to lock both numbers, and we'll drag this, hold shift and the right arrow and then Control R, quickly fill that in. So our cost of goods sold will be equal to our revenue times our percentage of sales. And then we could go ahead and hold shift and the right arrow and control R. And then for our gross profit, we already know it's our revenue minus our cost of goods sold. And we have this formula already written over here. So we go shift and right arrow, press control R. And we can do the same thing right here to fill in our percentage of sales. And for our operating expense, we'll need to do the same thing for our that we did with cost of goods sold to find what our number will be. So we'll take the average of 2 years before, then we'll go ahead and lock it. And we'll take this and fill it in quickly. And our operating expense will be our revenues times our percentage of sales for our operating expenses. And we could go ahead, shift and right arrow and control R to fill this in. In our EBITDA, we already have the formula set up. So we could take the last one and then press control R to quickly fill that in. Now for our depreciation and our interest expense, we will go over that later when we get to our debt schedule. So for now, we will just highlight these cells to make sure that we come back for it later. And our pre-tax income, we already have our formula for that, so we could go ahead and control R. And for our income tax expense, we will also need to come up with an assumption. So our assumption would be 1750, and we'll straight line this expense for now. And then let's hold control R one last time. And now we have filled in our income statement. We have projected 5 years into the future. Now let's go ahead and clean up our numbers the way we like it. So let's hold control C for copy. Now we'll call Alt H, B for paste, S for paste special, and our formats. Let's see, did it work? Yes, it did. So we could quickly do that for all of these numbers. So Alt H, B, S, and then T for formats to quickly do it. And we can keep doing it for all the numbers that we need to format the way we like. And there you go. Now we have done our first part of our financial modeling, which is building our income statement. And next we'll be moving on to our balance sheet. In part 2 of our financial modeling series, we'll now be going over constructing our balance sheet. So let's scroll down a little bit. As you guys can see, there's a balance sheet already there for you. So we'll scroll down to the bottom, and what we need to start on is working on our assumptions for our balance sheet. And the first one is our AR days, or our account receivable days. And to find this number, we will make this equal to accounts receivable divided by the revenue from the net income divided by the amount of days, so the 365 days in a year. And as you see, our AR days are 50. We'll drag this over very quickly. And for our inventory days, we'll set this equal to our inventory divided by our cost of goods sold from our net income divided by 365 as well. And for our AP days, we'll take our accounts payable and divide this by our cost of goods sold divided by 365 as well. And we'll go down here and drag these days over. And next, for our assumptions, we'll take the average of our historical data, so the first 2 years, and that will be what we'll use for each of the 5 forecast years we are doing. So average, we'll select these 2 years, click F4 to lock it, close parentheses, and let's fill this, Control R, do the same again for inventory days. Drag this over. And lastly, for our AP days. So for our inventory days, I forgot to lock our formulas. So I need to go back in there. So our formula bar, press F4 to lock it, and then re-drag this out and fill it in again. And same thing for our AP days. Let me go back in here and lock this. Let me fill that in. So there we go. Now we have our balance sheet assumptions ready and good to go. So now let's fill in the balance sheet. Cash we'll work on later when we get to our scheduling or our cash flow statement, and we'll be able to fill in our cash. So for our account receivable, the formula will be equal to our revenue from our net income divided by 365 times our AR days. And we'll hold Shift and right arrow and Control R to fill that in. Next, for our inventory, we'll do something similar. So we'll make this equal to our cost of goods sold divided by 365 times our inventory days. And we'll go ahead and fill this over, Control R. And for our prepaid expenses, we're going to straight line that. So we're just going to hold Shift and the right arrow, press Control R, and our total current assets will be the sum of all of these numbers right here. And since we already have this formula over here, we just drag and press Control R, and it'll fill it in for us. PP&E, we'll be going over this later when we go over our debt scheduling. So we'll save that for later. And our total assets, the formula is already in there. So once again, we'll go here, Control R, and it'll fill it in for us. So now for our current liabilities, our accounts payable, we do similar to what we did with our inventory and accounts receivable. We'll make this equal to our cost of goods sold divided by 365 times our AP days for that year. And we could go ahead and Shift and the right arrow and Control R to quickly fill out the rest of that. For our line of credit, we'll be straight. Now for our line of credit, we'll actually be going over that later with our debt scheduling. Same thing with our current maturities of long-term debt. So we can highlight that. And we already have the formula for our total current liabilities. Go ahead and Control R. For our long-term debt, we'll also be working on that later in our debt scheduling. So we go ahead and highlight these cells. And for our total liabilities, we'll drag this over the formula, and it'll be the sum of our total current liabilities and long-term liabilities. And now for our common stock, we will straight line our common stock. So hold that last one over, Control R. Same thing with additional paid in capital. Shift and the right arrow, Control R. And now for our retained earnings, our retained earnings will be equal to our retained earnings from the previous year plus our net income from current year. And we can drag this over as well. And now our total equity will be the sum of these three line items, and we already have this formula here, so we go and press Control R. And now for our total liabilities and equity, we'll just add the two total liability, total equity line, Control R. And now for our check is to make sure that our total assets is equal to our total liabilities and equity combined. As the accounting statement go, assets equal liabilities plus equity. So for the check, you want it to equal 0. So as you see, the first two historicals are good. They equal 0. And for our projected years, they do not equal 0 right now because there are quite a few line items missing from our balance sheet. And when we fill those in, everything will should equal out to 0. And if it doesn't, we can always go and check and see where we made a mistake. But for now, that'll be our balance sheet. This video, we'll now be going over the statement of cash flows. So first line of our statement of cash flows are net income. So we go ahead and take that from our income statement and quickly fill that in. We'll go ahead and hold shift and the right arrow and drag that across. Now our next line item is our depreciation, and we still haven't done our PP&E schedule to get that, so we will highlight those. And for now, we will give 0 to our amortization. And now for our accounts receivable, our changes in working capital, we'll have to take the previous year accounts receivable from the balance sheet, and we'll subtract it by the current year accounts receivable, and it should come up as a negative number if you gain money in your accounts receivable. And the same thing with inventory. We'll take the previous year's inventory and subtract it by the current year's inventory. Now for accounts payable, since it is a liability, we'll do the opposite. We'll take the current year's accounts payable and subtract that by the previous year account payable, and you see it come up as a positive number. And our net cash provided by our operating activities will be equal to the sum of our net income plus our depreciation. Oh, I don't have to press plus since we have sum already going. So just comma plus our depreciation, comma amortization plus accounts receivable, inventory, and accounts payable. And we could go ahead and highlight these formulas, and we could drag them and fill them in all across. And now we have our operating activities cash flow. Now to move on to investing activities. Since we don't have our PP&E schedule yet, we'll go ahead and highlight these cells. And we'll come back to that later. And this will be equal to our PP&E. Go ahead and drag that across. And same thing with our cash flow from financing activities. Since we haven't done our debt schedule yet, we're going to highlight these cells as well. And this will be equal to the sum of these two cells. And we can go ahead and fill that in. And now our net cash flows will be the sum of all of our net cash from each activity. So from our financing activity, our investing activity, and our operating activities. So equal sum there goes some of our operating activities, some of our investing activities, and our financing activities. That'll be our net cash flow. We could go ahead and fill that in. And now for our beginning cash balance. Our beginning cash balance, since this would be looked at as the first year, we could take our ending cash balance from the previous years on the balance sheet. So we'll make this equal to the cash from the previous year. And this will be equal to the sum of the net cash flow and the beginning cash balance. And we can go ahead and fill this in. And now that we have filled in our ending cash balance, we could fill in our cash that we have in the balance sheet. It will be equal to the cash balance, ending cash balance of that year, and that'll be our cash for the balance sheet. We could go ahead and right arrow and Control R to fill that in. And let's go ahead and take away our background field now that we have filled that in. So Alt H, and N for none. And there we go. Now we have filled in our statement of cash flow. We still have a few line items that we will need to get to, and we'll get to those line items in these next couple of videos when we go to our supporting schedules. In our fourth video of our financial modeling series, we'll be going over creating our debt series. So let's begin with our first line item, which is the cash balance at the beginning of the year. And we can make that equal to our beginning cash balance right here from our cash flow statement. Go ahead and drag that over and fill that in. Now our next line item is our free cash flow from operating and investing. So we'll make that equal to the sum, and we'll go up here to our cash flow statement and find our operating activities and our investing activity sum, and press enter, shift right arrow and Control R to quickly fill that in. And we need our free cash flow from our financing activities, but we don't want to include our line of credit, so that will just leave us with our long-term debt. So we'll make that equal to our long-term debt. And go ahead and fill this in. And now we want to keep a minimum cash balance. Companies will want to keep a minimum amount of cash on hand, and we'll make that equal to $3 million. So $3 million is the minimum amount of cash we want to keep on hand. And now for our line of credit, we'll go ahead to our balance sheet and fill it in from our historical data. So our line of credit, enter, and we could quickly fill that in. Put that in the wrong line, so let me go ahead and Control X for cut and Control V for paste. And our total cash available right here will be equal to our sum, or not the sum, but it will be equal to our cash balance at the beginning of the year plus our free cash flows from operating investing plus our cash flows from financing minus our minimum cash balance. Let me go ahead and quickly do some formatting real quick. I just want to make everything look neat very quickly. So let's go ahead and fill this in. And now our line of credit will be equal to the max of the number 0, or our line of credit from the previous year minus our total cash available. And all this is saying is that if it is 0, we have enough cash available to pay off our line of credit from the previous year. If we didn't, it will show up as how much leftover line of credit we'll still need to pay. So now we can go ahead and quickly fill that in. And let me scroll down. So now our next thing that we'll have to do is our long-term debt, and we could get that from our balance sheet. debt, Control R, and our current portion of long-term debt, which we could also get from our balance sheet. So for our current portion of long-term debt, we'll make that equal to 500 throughout all the years, and this is just how much of our debt we'll be paying down per year. So we can equal that to 500,000. Go ahead and fill this in. And now for our long-term debt, it'll be equal to our previous year long-term debt minus how much we are going to pay down on it for the current year. And we could go ahead and fill that in as well. Now let me scroll down a little bit more, and our interest rate for our long-term debt and our line of credit will be our assumption. So for both of these, we'll make up our own number, and let's choose 8% for our interest rate on long-term debt and 5% for our interest rate on our line of credit. Let's go ahead and fill this in. We can straight line it for all the years. And now our interest expense on our long-term debt will be equal to the average. And then we'll take the sum of the previous year's long-term debt and current portion of long-term debt, and the sum of the current year's long-term debt and current portion long-term debt. And we will multiply that by the interest rate on our long-term debt. And now we'll go ahead and fill that to the right. And similarly, for our interest expense on our line of credit, it will be equal to the average of our previous year's line of credit and our current year's line of credit times our interest rate for our line of credit. Go ahead and drag that and fill that in as well. And our total interest expense will be equal to the sum of our two interest expenses right here. And we could go ahead and fill that in. Now we have finished our debt schedule. So let's go ahead and put in these numbers to our income statements in our balance sheet. So our interest expense will be equal to our interest expense that we just finished, our total interest expense. The cell is not linking right now, so just to save time, I'll quickly go ahead and type these numbers in. 414, 340, 300, 260, 220. $300, 300, 260, and 220. And we could go ahead and get rid of this background color that we have by pressing Alt H, H, N. And we can also fill in our line of credit in our balance sheet. We'll make that equal to our line of credit down here. We can go ahead and fill that in. And we also can do the same with our current maturities on our long-term debt. That and fill that in as well. We could go ahead and get rid of the background color. And we could also fill in our long-term debt right here and link that to our debt schedule as well. There we go. Fill that in and drag in, press Alt H, H, N, and get rid of that background color. So our balance sheet now has everything but our PP&E filled out. Our income statement has everything but our depreciation line filled out. And in our cash flow statement, we could go ahead and fill this in as well. So for our cash flow statement, we'll take this year's line of credit and subtract it from last year's line of credit for our line of credit from our financing activities, and we'll go ahead and fill that in. And we'll do the same thing with our long-term debt. Take this year's long-term debt and subtract it from last year's long-term debt. or by last year's long-term debt. And we'll go ahead and fill that into Control R. And let's go ahead and get rid of the background color. And now all we have left for our financial modeling series is our PP&E schedule. You have made it to the last video of our financial modeling series, our PP&E schedule. So let's go ahead and begin. And we'll start by using our depreciation line. So we'll take our depreciation as a percentage of our revenue, and we'll make that equal to the depreciation from our income statement divided by our revenue. And we'll drag that over for 2 years. And then for the next years, we'll take the average of our historical data and we'll lock this in place by pressing F4. And that will be our depreciation percentage of our revenue over the next 5 years. And now our depreciation will be equal to our revenues times our percentage of our revenues. So now we have our depreciation number. And we also need to get our beginning PPE, and this will be equal to the previous year's PPE. We can find this in our balance sheet. So here we go. That will be equal to our previous year's, and we could fill that out for now. And now our capital expenditures, this will be our assumption, and we want to make sure that our capital expenditures is outgrowing our depreciation. So our assumption will be $3,800,000, and we'll have this grow by $500,000 per year. So this will be equal to 500 plus the previous year. And we could drag this formula over and fill this in. And now our end PPE will be equal to our beginning PPE plus our capital expenditures minus our depreciation. And now let's go ahead and drag this over and fill this out. As you can see, we still need to have our beginning PPE filled out, and that's linked to our balance sheet. So what we're going to do is go ahead and link our balance sheet PPE right here. And we're going to link that to our PPE schedule, our end PPE. And we could go ahead and fill this out. And let's drag this over, Control R to fill in, and Alt H N. And now as you can see, if we go down our PPE schedule, our beginning PPE has been filled in. We have finished our PPE schedule, our last part of our financial modeling. So let's go ahead and fill in everything else that we have to fill in to complete it. Let's go up here to depreciation. And we're going to make our depreciation equal to our depreciation down here. We could go ahead and fill this in, Alt H N to get rid of the background. And we could also fill this in our depreciation right here. Make this equal to our depreciation line from our PPE and go ahead and fill this in as well. And we could get rid of the background color, Alt H N. And last thing we have to do is our capital expenditures. So our capital expenditures will be negative, so we have to make it equal to negative and take our capital expenditures down here and fill this in. Oh, one line too low. Fill this in, and we'll go ahead and get rid of our background color as well. So now everything is finally filled in our financial modeling. All of our statements are integrated. Everything is completely filled in. As you can see, our sheets are balanced. As you can see from our check, everything balances out. Everything's equal to zero. We have major financial model. I hope you guys are glad. I hope you guys learned a lot from this series, and I hope you guys will feel confident when going to learn how to build integrated financial statements. So what is financial ratio analysis? Financial ratio analysis is the quantitative analysis of information contained in a company's financial statements. This ratio analysis is based on the line items in the financial statements, such as the balance sheet, income statement, and cash flow statement. And the ratios of one item or a combination of items to another item are then calculated. Ratio analysis is used to evaluate various aspects of a company's operating and financial performance, such as its efficiency, liquidity, profitability, and solvency. The trend of these ratios over time is studied to check whether they are improving or deteriorating. Ratios are also compared across different companies in the same sectors to see how they stacked up and to get a comparative idea of comparative valuations. Ratio analysis is a cornerstone of fundamental analysis. So here we go. I have broken up the financial ratios into four different sections. We have our performance ratios, which measure the performance of the company, how it's doing. We got our gross profit margin ratio, our operating profit margin ratio. Then we have our net profit margin ratio. And then we have our return on assets, or ROA, our return on equity, ROE, and our earnings per share, also known as our EPS, and our price earnings ratio. And then under our liquidity ratios, we have our current ratio, our asset test ratio, our net working capital. In financing ratios, we have our debt ratio and our debt to equity ratio. And for our activity ratios, we have our asset turnover and our inventory turnover. And in these next few videos, I'll be going in much more depth about each of these ratios, what they mean, what a good ratio is, what number would be a good ratio. And then I'll take you to our financial statements in Excel, and I'll show you how to the equations for the ratios and how to get the numbers for the ratios that we are looking for. Now let's take a more in-depth look at performance ratios. So the first ratio we have is our gross profit margin ratio, which is our sales or revenue minus our cost of goods sold divided by our total sales. And as we can see, our gross profit margin is a financial metric used to assess a company's financial health and business model by revealing the proportion of money left over from revenues after accounting for the cost of goods sold. Gross profit margin is calculated by dividing gross profit by revenues. So this is a quick way just to see our profit margins just from our sales and our cost of goods sold without taking in any of the other expenses. Our next ratio we have is our operating profit margin, which is our earnings before interest and taxes divided by our sales. And this is similar to our gross profit margin, but we're also taking away our SG&A expenses and our depreciation and amortization expenses. So our operating margin is a measurement used to determine what proportion of a company's revenue is left over after paying for variable costs such as SG&A and raw materials. It can be calculated by dividing company's operating income during a given period by its net sales during that same period. Operating income here refers to the profit that a company retains after removing operating expenses. Our next ratio is our net profit margin, which is our net income divided by our sales. And this gives you the most overall look about how much money you're making from each sale, because it accounts all of your expenses, your operating expenses, your taxes, your interest. So our net profit margin is a financial metric used to determine how much money a company is making from each sale after accounting for all expenses. For example, a profit margin of 35% means that for every dollar of total revenue, the company makes 35 cents. Our next ratio will be our ROA, or return on assets. And this is our net income divided by the average of our total assets over a 2-year period. So a company's ROA shows how profitable a company is relative to the amount of assets it has. This metric shows how efficient a company is using its assets to generate income. So what this does, it takes your assets and shows you how much money you're making from your assets if if you're being efficient with that or not. And next we have our return on equity, or ROE, which is similar to our ROA. It's our net income divided by our total equity instead of total assets. So a company's ROE shows how profitable a company is relative to the amount of equity it has. This metric shows how efficient a company is using the money invested by shareholders to generate more income. Now our next ratio is our earnings per share. So this goes into our stock prices and our shares in that. And so this will be our net income divided by our dividends. Our net income subtracted by our dividends divided by our average shares outstanding. And the earnings per share is the portion of a company's profit allocated to each outstanding share of common stock. Earnings per share serves as an indicator of a company's profitability. And lastly, we have our price earnings ratio, which is our market price per share divided by our earnings per share. And this ratio is used for valuing a company that measures its current share price relative to its per share earnings. And now I'm going to take you over to Excel and show you how to do that with our income statement and our balance sheet, how to get these ratios. So now let's turn our attention to this Excel worksheet I have created. And as you can see, there's a balance sheet here set up for 3 years. And right under that, we have an income statement set up for 3 years over the same 3-year period. And now what we're going to do is we're going to go into Excel and we're going to actually make these ratios that I have just told you about. So right here you can see we have our performance ratio set up. And our first ratio will be our gross profit margin. And we do this by taking our gross profit. So we're going to make this cell equal to, find our gross profit from our income statement, and we're going to divide that by our total revenue. And we're going to turn this into a percentage. And then we're going to quickly just fill it in to the right. And now we have our gross profit margin for our 3-year period. And what this shows is that our gross profit for all of our sales is 46%. So for every dollar we're selling, we're profiting 46% just after taking our cost of goods sold in account. Now we're going to go and use our operating profit margin. So we're going to make this cell equal to our EBIT, and we're going to divide this by our revenue. And once again, we're going to turn this into a percentage, and we could quickly fill that in right. And here you can see that there's a big drop off from our gross profit margin to our operating profit margin. So that means we have some big expenses in our SG&A, and that can be concerning. You don't want to see that big of a drop off. You might want to look in what's causing these problems with depreciation or raw materials, or how much money we're paying our employees. So all that could be reasons for the big drop off between our gross profit margin and our operating profit margin. Now lastly, we're going to see our net profit margin. So we're going to take our net income and we're going to divide that by our total revenue. And once again, we're going to turn this into a percentage, and we're going to go ahead and hold shift, right arrow, and control R to fill that in right. And as you can see, there's not a big drop off from our operating profit margin to our net profit margin, which is good. That means our income and our tax expense is not too much, and our interest expense is not too much. But out of everything, out of our sales that we're making after accounting for all expenses, we're making about 12%. So for every dollar, we're making 12 cents on the dollar. So you might want to look ways that we can retain more and cut out some of those expenses. Now we're going to go ahead and use our ROA, our return on asset, and this will be equal to our net income divided by, we're going to put this in parentheses right here, divided by, let's use 2 parentheses actually, divided by our total assets for the current year plus our total assets from the previous year. We want to average out our assets from over the past 2 years, and then we're going to divide that by 2, like I said, so we can average that out. And we're just going to press enter, and we're going to turn that into percentage as well. And I'm going to hold shift and the right arrow and then control R. And return on assets, it just shows how we're converting our assets into money. And as you can see, we started out really good in 2014, and then there was a big drop over the next few years. And it's interesting because our net income was a lot lower in 2014, but our return on assets is still higher. So you want to go through and see what we're doing and why our return on assets has dropped so dramatically over the years, and see what expenses that we've added. Maybe we added too much inventory, we're not selling all of our inventory, so maybe we could cut back, and this just shows you that. And lastly, we're going to do our ROE, or our return on equity, which is similar to our, let me go ahead and delete that. So lastly, we want to use our ROE, which is similar to our ROA, as in we're going to make it equal to our net income, and then we're going to divide it by the average of our total equity instead of our total assets over a 2-year period. So we're going to go to our balance sheet and find our equity plus this year's equity, and we're going to divide that by 2. And there we go. And we can turn this into a percentage as well. And we're going to just fill into 1 year over, and we're actually going to delete this 2014 year return on asset. And the reason for that is because since we were in 2014 and we were using the average of our assets, there was no year before that to average. So you can only use 2016 and 2015 for our ROA and our ROE. And here on return on equity, you can see it improved, which is good. You don't always want to compare your ROA or ROE with other companies. You kind of want to compare it against your previous years to see that you are improving. So these are our performance ratios. This is how to use them in Excel, how to create them. And next we'll be going over our liquidity ratios. So now let's take a more in-depth look at our liquidity ratios. Liquidity just means how fast you could turn your assets into cash. So if you needed cash now, what assets could you use, which is normally your current assets. You don't look at your property, your plant equipment, or your long-term assets. It's just how fast you could turn your assets to cash right now. So our first ratio is our current ratio, which is current assets divided by current liabilities. And this ratio is used to determine a company's ability to pay their short-term debt with their short-term assets. And as you can see, it quickly shows you want to have a ratio over 1. That means your current assets will cover your current liabilities. If it's under 1, that means you have more current liabilities than current assets to cover if you are ever in trouble and you need to cover that quickly. Our next ratio is our asset test ratio, or also known as the quick ratio, which is your current assets minus your inventory and prepaid expenses divided by your current liabilities. So this ratio is much similar to the current ratio, but excludes the inventory and prepaid expenses, which can be harder to turn into money as quickly. That's why we take that away from our current assets, and we want to just use like our accounts receivable and our cash. And this ratio is a strong indicator for whether a firm has a sufficient short-term assets to cover its immediate liabilities, once again. And lastly, we have our net working capital, which is simply our current assets minus our current liabilities. And this metric shows the company's short-term health just by subtracting its liabilities from its assets. So you want to have obviously a positive number, and it'll give you a cash number of how much assets you have left, current assets you have left over after covering all of your current liabilities. And now let me take you to the Excel worksheet to show you how to do these formulas. So for our first ratio, for our liquidity ratio, we have the current ratio. And as I said earlier, that is our current assets. So we're going to go up into our balance sheet and find our total current assets. and we're going to divide that by our total current liabilities, and we'll press enter. And we're going to leave that as a number and not turn that into a percentage. But what we can do is take away some of these decimal places, and then let's just hold shift and the right arrow and hold control R to quickly fill that in. And now for our asset test ratio, we're going to equal that once again to our current assets, our total current assets, but this time we're going to subtract our inventory, and we're going to subtract our other current assets from it as well. And put that in parentheses and divide that by our total current liabilities. And we want this to be just a number. And we could go ahead and fill that in as well. As you can see, our asset test ratio is not as high as our current ratio because we subtracted some of the current assets out of it, but it's still a positive number, which means we can comfortably cover our current liabilities, which is good to know. And lastly, we have our net working capital, which is just simply our total current assets subtracted by our total current liabilities. And then we can just fill that in, and as you can see, we're doing well. After covering all of our current liabilities, we still have over $9 million in most of the years left over if we had to hurry up and go liquid in case something went wrong. And those are our liquidity ratios. In this video, we'll be taking a more in-depth look at our financing ratios, which is basically how we use debt to finance our company, also known as leverage. So our first ratio is our debt ratio, which is our total debt divided by our total assets. And this measures the extent of a company or consumer's leverage. As I said, leverage is using debt. So you pay so much and you get this much back in return in loans to finance your company. Higher levered companies means they're taking on more loans to pay for their company, and lower levered companies mean less. And the debt ratio is defined as the ratio of total debt to total assets, and it can be interpreted as the proportion of a company's assets that are financed by debt. Next, we have our debt to equity ratio, which is our total debt divided by our total equity. And this is also used to measure a company's financial leverage, but instead this shows how much debt is being used compared to equity. So how much is being invested into the companies from stockholders and other shareholders, and how much money we're taking on from loans. And this just shows you the balance between that. So now let's go ahead and go to Excel so I can show you how to do these formulas. So our first ratio is our debt ratio, like I said earlier, which is equal to, so we're going to put equal in parentheses, and then we have to go to our balance sheet to find our debt, which we'll find in our liabilities. So we have our short-term debt, and we're going to add our long-term debt as well, and we're going to divide that by our total assets. And let's go ahead and make that into a percentage. And the next thing that we would do is fill it in to the right, so control R. And now let's do our debt to equity ratio, which is going to be similar to our debt ratio, except we're going to use our total equity instead. So parentheses, and once again we're going to go ahead and find our short-term debt and add that to our long-term debt, and then we're going to divide that by our total stockholder equity. And once again, we're going to turn this into a percentage and fill into the right. So you can see we're not too highly of a levered company. We're not taking on a bunch of debt. It's only 10% compared to our assets. It comes from debt. So probably a lot of our is either other liabilities or equity that we're getting from shareholders and investors. And lastly, for our financial ratios, we have our activity ratios, which shows the company's activity, how they're using their assets to generate sales and the inventory and how they're turning things over. So first we have our asset turnover, which is our sales divided by total assets. This ratio shows the value of a company's sales or revenues generated relative to the value of its asset. This ratio is often used as an indicator to show the efficiency in which a company is using its assets to generate revenue. So basically, are the assets that we have that we bought, all the inventory and the plant, the property and the equipment and the cash we're putting it, is it turning into revenue for us? And next we have our inventory turnover, which is sales divided by inventory. And this ratio just shows how a company's inventory sold and replaced over a period of time. Is our inventory turning into money for us, or is our inventory sitting on the shelves and not turn not making money for us as it should be? So now let's go to Excel and I'll show you how to do these formulas as well. So the first ratio we have is our asset turnover, which will be our sales, or also known as our revenue. We can find that in the income statement, divided by our total assets, which we can find in the balance sheet. And we could take away some decimal places, and that is our asset turnover. So that means our sales are generating 1.5 more money than our total assets, which is a good thing, which means our assets turning into money for us. And let's look at our inventory turnover. So we're going to find our inventory in our balance sheet. Well, first we're going to find our sales actually in our income statement. And we're going to divide that by our inventory that we can find in our balance sheet under the current assets section. Take away some decimal places, and we can fill that in very quickly. And what you just want to see, you want to compare your turnovers. First, you want to make sure that's positive, that you're not losing money, which is good. Then you want to compare these numbers, all of these ratios, to the previous years and see if you're improving, especially with these activity ratios. You want to see that you're becoming more efficient with turning your assets into revenue, or your inventory into revenue. As we can see here, our inventory took a down year in the most recent year, from 2015 to 2016, and we want our inventory to be our turnover to be rising, our inventory to make more sales and generate more revenue for us. And these are all of our financial ratios. There are much more ratios, but these are the main ratios that a company will look at to get a good picture of how they're doing and how they're standing. Congratulations on making it to the end of this course. And now, just to wrap up, I want to leave you with one thing, and that is it's important for you to keep practicing. Practice everything that you learned throughout this course, and that is the only way that you will become a pro and comfortable with financial statements. You could go on places like Yahoo Finance to download these financial statements, and you can use them to practice with your financial ratios. You can practice building them from scratch and see if you can match them up. There's many ways you can practice financial statements and analyzing and building them, but it's important that you just do it, keep practicing, and you'll only get better. Once again, thank you for choosing this course, and congratulations on completing it.